And so one thing I've been pointing out for years is that you can have a multipolar world where, Chinese currency is kind of the main currency over in East Asia. The United States' dollar is, the currency in our hemisphere and other parts of the world, and Europe's is kind of, their part of the world and their biggest trade partners in periphery. So you can have kind of three currency blocks of different sizes. You can have an elevation of neutral reserve assets. So he specifically calls out that this plan would be good for gold and cryptocurrencies over time. Funding currencies that are cross-border can shift a little bit. There can be different incentives to maybe have the world shove less of its asset flows into U.S. assets and instead buy things like gold or Bitcoin or potentially some other assets from other countries and kind of diversify this to some extent.
Since taking office in January, the Trump administration has laid out bold plans to rejuvenate American industry, safeguard domestic jobs, and reshape the global trade system. But as macro analyst Lyn Alden highlights, the real challenge runs far deeper. At its core, it's about addressing long-standing structural imbalances that have been building for over 4 decades, chief among them, the U.S. current account deficit. In simple terms, America consumes more than it produces, bridging the gap with foreign capital. This includes not just trade deficits, but also income flows like interest and dividends, which over time have become embedded in the fabric of the U.S. economy. This imbalance has significant consequences. Foreign investors, flush with U.S. dollars, purchase American assets, stocks, real estate, and government debt. While it may appear to be a fair exchange, goods for paper, this ongoing capital inflow has steadily shifted economic power. Wealth has become increasingly concentrated in financial hubs like New York and Silicon Valley, while industrial regions such as the Rust Belt have been left behind. The result? A hollowed-out manufacturing sector and deepening regional inequality. What might be overlooked over a few years becomes undeniable after 4 decades, sparking political unrest and creating a fractured economy. For the Trump administration, this presents both a monumental challenge and a unique opportunity to restructure the system. In today's video, Lyn Alden explores how these imbalances took root, what a rebalanced future might entail, and how alternative assets like gold and cryptocurrencies could serve as stabilizing forces in the years ahead.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
I can imagine the administration's challenge of trying to communicate this because the intricacies of how trade deficits and the reserve currency kind of pair together is very wonkish. It kind of has this academic quality to it that doesn't go over well in kind of political-oriented speeches. I'd be terrible at a political rally, for example, when I try to explain any of this. And so we kind of have this situation where, and this was outlined back during the Bretton Woods system by Triffin, as you mentioned, which is that having the reserve currency does come with a bunch of benefits. Is historically called a exorbitant privilege, but then it has certain costs to maintain it. And those costs can vary a bit depending on how the system's structured. So, for example, back in the Bretton Woods era, the cost was that we kept draining our gold reserves. We basically had to kind of keep paying out our gold reserves to maintain that part of the system. And in the current formation, instead, we kind of pay for it with our industrial base. We keep kind of sending out little parts of our industrial base over time to maintain the global reserve currency status. And there's a few reasons for that. One is that because unlike every other fiat currency, the dollar has all these extra demands for it by countries all around the world. All these different purposes, there's this extra demand for dollars, which sounds good on the surface. And as for Americans, for example, we have tons of import power. When we go on vacations to the rest of the world, we have pretty strong purchasing power compared to when they come to the US. These things seem good on the surface, but it also means that it's pretty expensive to manufacture lower margin things here at home. And so we have this kind of situation where our imports are very strong. Our exports, especially lower margin stuff, is less competitive, whereas we can still be competitive on really high margin stuff, technology, finance, healthcare, that kind of thing. And then the other aspect is that even if you could somehow solve that, there's a more fundamental problem, which is that the whole world needs dollars for the global reserve currency status to use it for international contract pricing, cross-border financing, one side of every trade pair that they do, all these different purposes as a reserve asset. And when you step back and say, well, how do they get all those dollars? If they're all using dollars, how did all those dollars get out there? And the answer is trade deficits. Basically, that overvalued aspect forces open the U.S. trade deficit. And every year we send out hundreds of billions or sometimes $1 trillion in net outflows. And over years and decades, these have accumulated out there. And so kind of the way it works is that if you want to fix the trade deficit, which I've been writing about since 2019, I think that's a valid mandate to do. Unfortunately, it does come with trade-offs. Some of the benefits that we enjoy at the cost of the trade deficit, if you do want to kind of fix that imbalance, it comes up, with basically giving away at least some of those benefits and prioritizing that industrial base a bit more. And so basically the opposite side of a current account deficit, which is basically the trade deficit plus things like interest and dividends. So we run a structural current account deficit, and the opposite side of that is a capital account surplus, which is that funds flow in the rest of the world and buy our financial assets. And so it's the trade deficit is often described as us sending out pieces of paper and getting goods and services, which sounds like a really good deal. But then the extra step of that you mentioned is that they take those slips of paper, or really those electronic digits that they have, and then they buy our stocks, they buy our real estate, they buy our private equity, they buy our corporate bonds and government bonds. And so they end up owning a larger and larger share of corporate America as part of their kind of accumulated trade surpluses and reserve assets and international private assets. The consequence of this, if you kind of like view the foreign sector as an intermediary, we're basically constantly kind of taking economic vibrancy out of Michigan and Ohio and rural Pennsylvania where the steel mills were. We're kind of taking it out of our Rust Belt, causing it to become the Rust Belt. And then we're stuffing it back into financial assets in New York and Silicon Valley and certain other places, mainly along the coasts. And this went on for approximately four plus decades, really ever since you can say kind of the early 80s. This really kind of started. And these are cumulative. So 1 year of that is not a giant deal, but when you have 4+ decades of it, that causes major imbalance. And a lot of academics will say, well, there's still room to go. This is not kind of an emergency. But on top of that, there is this political overlay that basically that voters get angrier and angrier when they're on the wrong side of that imbalance. And although many of them, they don't work in finance, they might not be able to articulate the exact mechanisms that are causing it, but they have this feeling that something's rigged against them, that something is just not right, that they're constantly going uphill, that they're on a treadmill. And so we start to see this it manifests in rising voter populism. It manifests in different priorities of when people vote. And so I do think that there's a pretty strong mandate to try to go after the trade deficit. But I think the way I look at it is that because it's decades in the making, the best that any kind of one term can do is try to, start changing the direction of it. But it's inherently kind of a multi-year, potentially multi-decade project to kind of fully reverse these really long-term trends.
The Global Reserve Currency Challenge, famously introduced by economist Robert Triffin in the 1960s, is known as Triffin's Dilemma or Triffin's Paradox. It describes a fundamental conflict faced by any nation whose currency serves as the world's primary reserve. To support global trade, investment, and financial stability, the world needs a stable and widely available reserve currency. However, for this to happen, the issuing country, currently the United States, must run persistent current account deficits, effectively exporting more dollars than it brings in. While this satisfies international liquidity demands, it creates domestic issues like rising debt, inflation, and a loss of confidence in the currency's long-term value. A historical example of this dilemma played out with the collapse of the Bretton Woods system. In that era, the U.S. was required to supply enough dollars to support global growth, but those dollars were meant to be backed by gold. As the volume of dollars in circulation increased, doubts grew over whether the U.S. had sufficient gold reserves to cover them. This ultimately forced President Nixon to abandon the gold standard in 1971, effectively ending Bretton Woods. The Triffin dilemma still lingers today. The U.S. dollar remains the dominant global reserve currency, and America continues to face the impossible balancing act between satisfying global demand for dollars and safeguarding domestic economic health. According to macro analyst Lyn Alden, this paradox remains one of the most persistent challenges in international economics. Any attempt to resolve one side of the issue, whether it's boosting domestic stability or ensuring global liquidity, tends to exacerbate the other. Alden suggests that the only viable path forward is a long-term, multifaceted approach aimed at addressing deep-rooted structural imbalances in the global economy.
I think I would separate into three things. One is kind of the mandate, two would be the plan, and three would be the execution. And I think the issue is that they start off good and then they kind of deteriorate as you go through those three steps. I think the mandate is there. So there's some people in politics that would disagree that the mandate's even there. They say we shouldn't be going after the trade deficits or they're not a big deal. I disagree with that. I do think that, and I've been writing about this for years, that the imbalances have become big enough that they're actually starting to really matter. Financially, politically, they're actually a big deal now. And if you don't ever focus on addressing them, given the network effects involved, eventually it forces itself closed anyway, but that's from a position of weakness. So it's better to kind of get ahead of it before it's kind of fully metastasized and there's really no options left. You generally want to try to correct it from a position of strength. So I do think that there is a genuine rising mandate to reverse some of these multi-decade flows that are basically all going in one direction. So I think that part is sound. The second part would be the plan. And if you look at probably the smartest version of the plan, it would be Stephen Myron. That's Trump's chair of the Council of Economic Advisors. He's an economist, and he laid out this paper back in November 2024, so right after Trump was elected. And he outlined it was like, I forget the exact title, but it's like basically how to realign global trade. And it's this paper that kind of articulates the problem. So he talks about Triffin's dilemma. He talks about the overvaluation of the dollar due to its uses as a global reserve currency, how the cost of that is basically undermining our industrial base, making us less competitive in manufacturing, and how some of those imbalances where the downside of that system have surpassed the benefits of the system for America broadly. And so he kind of analyzes different ways that this might be addressed, and then also goes over some of the risks of addressing them. Like it's not treated as like a surefire solution, but like if we were to go about this, what are the ways we could do it? What are our options? And they include things like, starting with some mild tariffs, which kind of is like if you treat it like a carrot and a stick, that's the stick. And then when there's kind of multiple mild tariffs on that are somewhat disruptive, that they could do some sort of currency accord, a series of trade deals that are in the United States' favor, that could then bring down some of those tariffs and start to maybe balance out trade somewhat. Then he faces the issue of, okay, well, what's next? What's after that? Because there's still the issue that if you want the dollar to be the global reserve currency, you have to supply the world with dollars. And so he focuses on, well, one, you could give up some of the reserve currency status. So it's not a Boolean thing. It's not like you either have global reserve currency status or don't. It's really a percentage thing. And so one thing I've been pointing out for years is that you can have a multipolar world where Chinese currency is kind of the main currency over in East Asia. The United States' dollar is, the currency in our hemisphere and other parts of the world, and Europe's is kind of, their part of the world and their biggest trade partners in periphery. So you can have kind of three currency blocks of different sizes. You can have an elevation of neutral reserve assets. So he specifically calls out that this plan would be good for gold and cryptocurrencies, which we mean Bitcoin. He uses the phrase cryptocurrencies. And so over time, funding currencies that are cross-border can shift a little bit. There can be different incentives to maybe have the world shove less of its asset flows into U.S. assets and instead buy things like gold or Bitcoin or potentially some other assets from other countries and kind of diversify this to some extent. And then there's also various mitigants, because if you weaken the dollar, you risk higher inflation, you risk higher bond yields at a time when fiscal deficits and U.S. interest expense are very high. So he talks about, as part of trade negotiations, terming out the debt, convincing countries like China or Japan to increase the duration of their treasuries and basically agree to get their reserve assets inflated away. And so I think the plan overall, it's articulately described.
Lyn Alden emphasizes that the economic imbalances facing the United States are not temporary disruptions, but the result of decades-long structural shift. Addressing them won't be quick or painless, but within this challenge lies a unique opportunity to fundamentally rethink the global financial system. At the core of this reimagined foundation could be Bitcoin. When Alden speaks of a multipolar monetary world, she's not simply referring to a dollar-euro-yuan balance, but a system where decentralized, neutral assets like Bitcoin and gold take center stage as reliable stores of value, free from the control of central banks and immune to overprinting. In Alden's view, the most sustainable path forward involves gradually reducing America's reliance on chronic deficits while encouraging a global diversification away from excessive dependence on U.S. assets. This shift opens the door for alternatives, and Bitcoin is emerging as a leading contender. With its built-in scarcity, global accessibility, and immunity to counterparty risk, Bitcoin stands out in a world struggling with debt, devaluation, and declining trust in traditional systems. It represents a fundamentally new kind of financial infrastructure, credible, decentralized, and resistant to manipulation. And the transition is already underway. From institutional investors quietly accumulating to entire nations integrating Bitcoin into their strategies, the evidence is building. The current system may not collapse overnight, but a new one is rising steadily beside it, block by block. For those who see what's coming, the message is clear. Bitcoin is no longer a fringe idea. It's rapidly becoming the backbone of a future economic order grounded in sound money, decentralization, and digital resilience.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.